Most people buy life insurance once or twice in their lifetime, usually under pressure and with incomplete information. That makes it one of the easiest places to make a permanent mistake. My role today is not to sell you anything, it's to talk you through how these decisions are actually made at a professional level, so you're not relying on rules of thumb, urgency, or blind trust. My name is Franz Vickerson. I'm a financial advisor and life insurance agent in BC and Alberta. For the past several years, my work is focused on helping families make long-term financial decisions that hold up under real life, not just good intentions. And that means spending more time on how the decisions are made and less time on pushing products. This session reflects the same framework I use with my own clients. By the end of the session, you won't need to take anyone's recommendation at face value. You'll understand the framework well enough to evaluate any life insurance proposal on your own and know whether it truly fits your situation. Whether you ever work with me or not, the goal is simple: it's to give you the same decision-making lens professionals use so you can approach this with confidence instead of pressure. This is not a sales presentation. It's meant to be a guided conversation about how professionals think about life insurance when the objective is protecting a family and not just selling a policy. Most people encounter life insurance only during moments of pressure, a new mortgage, a new child, or a stubborn fear. My goal today is to slow that conversation down and show you how these decisions are actually made, so you can be properly informed long before you ever sit across from a salesperson. Life insurance exists to solve financial problems that appear, especially if somebody's no longer here. Those problems fall into three categories: income replacement, so your family can maintain their standard of living; debt protection, to ensure mortgages and other obligations do not become a burden; and future costs and legacy, such as education funding, final expenses, or just leaving a meaningful gift to someone you care about. Everything else is really secondary to these three purposes. Our guiding principle has to be needs come first. Professionals evaluate life insurance by starting with the income replacement, debt protection, and future costs. What is missing is the insurance companies and the policy types. Those come later, only after you've identified the problem that needs to be clearly defined. This approach follows the needs-based sales practices endorsed by Canadian insurance regulators. Recommendations must prioritize your interests, disclose conflicts of interest, and remain suitable even if the advisor earned nothing from the outcome. So to understand your financial landscape, to tailor a plan that actually fits, we need a clear picture of your situation. This is a collaborative fact-finding process. Personal details such as age, gender, and smoking matter because insurers price risk statistically. Health history, including family medical history, matters for the same reason. Lifestyle plays a smaller role in life insurance, but can still be relevant. Financially, we review income, assets, debt, and existing coverage. This is not about making any judgments. It's about avoiding any blind spots that lead to policies that look fine on paper, but fail when they're needed most. And the core question of how much coverage is enough. There are two ways to answer this question. First is a rule of thumb, often expressed as a multiple of income, such as 10 to 15 times your annual earnings. It's fast, but it's incomplete. Second is a capital needs analysis, which calculates the actual amount of capital your family would need to remain financially secure. This is the most accurate method. Generalized multiples are not wrong, they're just insufficient usually. This is a stage where a lot of mistakes can occur. Calculating your precise need, there's a method called the DIE method. So professionals, we don't guess at your coverage amounts. We calculate them using the common framework, the DIE method. D stands for debt, loans, credit cards. I is income, meaning the annual income your family needs, multiplied by the number of years you want it replaced. M is your mortgage, and the remaining is E, is for education or your future costs. This framework translates life into numbers rather than emotions. From that total, you subtract any existing assets or insurance, and the remainder is the death benefit you need to plan for. Insurance isn't meant to create wealth, but it will temporarily replace it. Defining the core promise, which is the death benefit. The result of the needs analysis is that death benefit. This is a one-time lump sum payment to your named beneficiaries if you pass away while the policy is active. Its purpose is to provide immediate liquid capital to solve the problems we identified earlier. In Canada, this payment is tax-free to beneficiaries. It is not an investment and not a return. It is a transfer of risk from your family to an insurance company. And how do we choose the right tool for the job? Now, there are two main categories of life insurance, designed for different timelines. Term insurance is temporary protection for temporary risks. Permanent insurance is lifelong protection for lifelong needs. Think of term insurance as renting and permanent insurance as owning. Term covers high-cost years like mortgages and raising children, and is the most affordable way to obtain a large coverage. Permanent insurance never expires and is often used for estate planning, final expenses, or any legacy goals. Sometimes it can have a built-in cash value as well. The tool only enters the conversation, though, after we've defined your need. Now, taking a closer look at the term life insurance, term insurance aligns with peak financial responsibility years. Your coverage will last for a fixed period, often 10 to 40 years, with premiums guaranteed during that time. At the end, you can just let it expire, you can renew it at a higher cost, or you can convert it to permanent coverage without having to do new medical underwriting. The flexibility allows insurance to match real-world timelines. As your obligations disappear, your coverage can be reduced, and when the risk declines, the insurance should decline with it. Now, is a 20-year term right for you? A 20-year term is the most common choice because it often matches family timelines. Mortgages of 15 to 25 years, young children, income replacement until retirement, or the need to lock in low rates, they all align well with this duration. It's not really a recommendation, it's just an observed pattern. When the length of coverage is matching the length of the risk, your insurance becomes a lot more efficient and cost-effective. Riders. Riders are optional features added to a policy, such as a waiver of premium, child coverage, accidental death, or critical illness. They exist to protect the policy, not to really enhance the returns. In many cases, they're unnecessary. In some cases, though, they are appropriate. The mistake isn't that you added riders, it's just not understanding what they were for. It's definitely worth talking to someone about those. Now we're at the application and underwriting. So these are your next steps. Once an application is submitted, the insurer conducts underwriting. This is their risk assessment based on age, health, family history, lifestyle, and finances. Your timelines vary. Young, healthy applicants may receive approval within days. Older applicants often require medical exams, which can extend the process to weeks. And if there's additional medical information required, such as an attending physician statement, timelines really depend on those third parties. So some of the potential outcomes, there's 4 things that can happen after the application. You can be approved at standard rates. That's what your illustration will show you. This assumes average risk. You can be approved with a rating, meaning higher premiums due to an increased risk. There can be a postponement, often if you have a medical event coming up like a surgery, or there can be an outright decline, and that's when the risk is deemed too high. Even in decline situations, though, alternatives may exist, but they do require a separate discussion. So start with the proper needs analysis to determine the required death benefit. Decide how long each portion of coverage is needed. Compare pricing across insurers, keeping in mind that service quality and stability can matter as much as cost. Then consider riders, only if they address the specific risk. If questions arise, this is where professional guidance becomes valuable. Your policy in hand, a quiet, effective solution. Life insurance is not about predicting the future. It is about ensuring that people you care about are not forced to make financial decisions under emotional pressure. When structured properly, life insurance is quiet and unremarkable. It just simply works, and that's all it's meant to do. Thank you for watching. There is a tool to do your own needs analysis and get your own quotes from Canadian insurers. It's available on my website, franzvickerson.ca/insurance planning. There'll be a button on your left if you're already there, or you can follow the link below in the description. Thanks again for watching. Hope you learned something.